First, welcome to our deep dive on emergency fund liquidity and why a high-yield savings account might not be the best standalone solution. We'll explore how transfer delays can force you into high fees during emergencies, and how a cash management account with instant debit access can fix this. Let's get started. Next, here's our agenda. We'll begin with the HYSA problem, then explain the CMA solution. After that, we'll walk through setup steps and compare speeds and costs. Then, we'll discuss tax paperwork and why you still need a backup bank for services like Zelle. We'll reinforce learning with quick quizzes. And finally, we'll wrap with key takeaways and next steps. Meanwhile, a quick disclaimer. This content is for education only and not financial or tax advice. Bank features, fees, and transfer speeds vary by institution and region. Always verify with your provider and consult a qualified professional for your specific situation. Now let's define the core problem. Emergencies require immediate payments, but most high-yield savings accounts rely on ACH transfers that take 1 to 3 business days. That delay often forces people to use credit cards or even cash advances, which can add roughly 3% in fees or worse. By contrast, a cash management account with a debit card can authorize payments instantly and avoid emergency fees. Then, let's talk about the reality of high-yield savings accounts. They usually offer higher interest but rely on ACH for moving money. ACH can take 1 to 3 business days, and weekends or holidays can extend this window. Payment networks matter. Debit card rails authorize transactions instantly, while ACH does not. Additionally, microdeposit verification and fraud holds can lock accounts temporarily. In a real emergency, that delay often translates into expensive credit card usage. After that, consider a cash management account with a debit card. It provides instant spendability and often integrates sweep programs for coverage, though you should confirm FDIC or SIPC details. Many CMAs support ATM withdrawals. Verify which network and daily limits apply. Note that some CMAs do not support Zelle or certain peer-to-peer networks, so plan accordingly. While the yield may be slightly lower than a HYSA, the liquidity is usually worth it for emergencies. Next, here's how to set up. First, open a cash management account that offers instant debit access and a broad ATM network. Second, link your paycheck or your primary checking account and set the CMA as your emergency wallet. Third, keep your high-yield savings as an overflow for non-urgent goals. Fourth, maintain a secondary, zero-fee backup checking account at a traditional bank for Zelle access and redundancy. Fifth, test a small debit purchase and an ATM withdrawal to confirm instant access. Sixth, automate a small monthly top-up into the CMA to keep it active. Seventh, set low balance and large transaction alerts. Finally, document your daily limits, transfer cutoffs, and fees so there are no surprises. Moving on, let's compare speed and cost. A CH from a high-yield savings account is typically 1 to 3 business days at zero cost but risky during emergencies. CMA, debit purchases authorize instantly at low or no cost, but may be subject to daily limits. Using a credit card for an emergency is instant, but often incurs roughly a 3% fee or other charges. Cash advances are also instant but come with separate fees and high interest. Wires can be same day depending on cutoff times but are expensive. Zelle can be near instant and free, but it requires that both banks support it, and many cash management accounts do not. Next is a quick quiz. The question is, what is the primary risk of keeping your entire emergency fund only in a high-yield savings account? Option A, lower interest than checking. Option B, transfer delays that force costly stopgaps during emergencies. Option C, no FDIC insurance. Option D, too many tax forms. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Then, the correct answer is B. The main risk is the transfer delay, which can force you into using expensive alternatives like credit cards during emergencies. Liquidity matters more than yield in those moments. Afterward, let's cover paperwork. Banks issue Form 1099 INT if you earn $10 or more in interest during the year. Bank interest is ordinary interest income, not capital gains. Closing an account does not avoid the form. If you earn $10 or more, you will still receive it. Consolidating accounts generally reduces the number of tax forms you have to track. Regardless, keep records for all interest earned, even below the reporting threshold. Next, A true or false quiz. If you close a bank account mid-year after earning $10 of interest, you won't receive a 1099 INT. Is that true or false? You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Then, the correct answer is false. If you earn $10 or more in interest, you should still receive a 1099 INT even if the account is closed. Meanwhile, do not abandon your old bank entirely. Keep a secondary, zero-fee checking account as a fallback. Many peer-to-peer payment networks, such as Zelle, require traditional banks, so keep that access active. If your cash management account or debit card fails, the backup account becomes your lifeline. Maintain a small idle balance and test logins and transfers quarterly. Next, let's compare two philosophies. On the left, a liquidity-first setup uses a cash management account for emergencies and a high-yield savings account for overflow. This offers instant debit access and tends to reduce emergency fees, accepting a slightly lower yield. On the right, a yield-first approach keeps everything in a high-yield savings account, maximizing interest but exposing you to ACH delays and a higher chance of paying costly credit or cash advance fees during emergencies. After that, use this simple checklist. Open a cash management account with debit access and confirm the ATM network. Link a funding source and set alerts. Keep your high-yield savings for overflow rather than emergencies. Maintain a backup bank for Zelle and redundancy. Test a small debit and ATM withdrawal. Document limits, fees, and cutoffs. Finally, revisit your allocation quarterly. Now, here's the emergency timeline. If you use a CMA debit card, the merchant sends an authorization request and receives approval within seconds, completing your payment. If you only use a high-yield savings account, you initiate an ACH transfer, which remains pending for 1 to 3 business days. During that time, the emergency remains unpaid, and you may be forced to use a credit card, incurring additional fees. Finally, the key takeaways are: emergencies require instant access, so liquidity beats yield. A cash management account with debit solves the liquidity gap, while a high-yield savings account works well for overflow. Consolidating accounts reduces paperwork, though you should still expect a 1099 INT if you earn $10 or more in interest. Do not abandon your old bank. Keep a zero-fee backup for Zelle and redundancy. Above all, prioritize accessibility over minor yield gains for real financial security. As we wrap up, remember that a high-yield savings account alone can fail under time pressure because of ACH delays. A cash management account with a debit card delivers instant spendability in a crisis. Keep a backup bank for Zelle and resilience. Streamline your accounts to reduce paperwork while tracking 1099 INT rules. Put the checklist into action and test your setup this week. Before we go, if you found this helpful, please like the video, share it with a friend who needs a liquidity upgrade, and subscribe for more practical financial workflows. In the comments, tell us your current setup and what you'll change after watching. Thanks for tuning in.